On September 15, 2008, a firm that had survived the Civil War, 2 world wars, and the Great Depression ceased to exist before lunchtime. It took exactly 24 hours for the global financial system to begin seizing up like an engine without oil. The bankruptcy filing listed $613 billion in debt. That number is not a typo. It remains the largest corporate bankruptcy in American history, and it still holds the record. No one has managed to top it, yet. But this story does not start in 2008. It starts in 1844 in Montgomery, Alabama, with a dry goods store and a family of Bavarian immigrants who accepted cotton as payment. Henry, Emanuel, and Mayor Lehman built a commodities brokerage from nothing. They survived the post-Civil War collapse of the Southern economy by pivoting to New York. They helped found the New York Cotton Exchange. These were, by any measure, serious men. By the 20th century, Lehman Brothers had helped finance the railroads, the early airline industry, and major American retail chains. They were underwriters for Woolworth, Macy's, and RCA. For over a century, the firm was a pillar of American capital markets. Then came the 1990s, and the firm that had spent 150 years building a reputation discovered something more exciting than reputation: leverage. Leverage, in simple terms, means borrowing money to make bets larger than you could otherwise afford. When the bets win, the returns are spectacular. When they lose, the losses are also spectacular, multiplied by exactly the same ratio. This is not a subtle concept. Richard Fuld became CEO of Lehman Brothers in 1994. He would hold the position for 14 years, longer than almost any other major Wall Street CEO of his era. He was known internally as the gorilla. He took that as a compliment. Under Fuld, Lehman transformed from a mid-tier investment bank into an aggressive player in mortgage-backed securities. The logic seemed sound. American housing prices had never, on a national basis, declined year over year since the Great Depression. Lehman's models said they never would. The models were wrong. In the early 2000s, the American mortgage market was undergoing a quiet mutation. Banks were no longer holding loans on their books. They were packaging them, slicing them into securities, and selling them to investors worldwide. The technical term is securitization. The practical effect was that nobody had to care whether the underlying loans were any good. Lehman didn't just participate in this market. They accelerated into it. Between 2003 and 2006, the firm dramatically expanded its mortgage origination business, acquiring lenders including BNC Mortgage and Aurora Loan Services, both specialists in what the industry politely called Alt-A loans. The industry was less polite in private. Alt-A loans were extended to borrowers with limited documentation of income, assets, or employment. They were sometimes called liar loans, not by critics, but by the people issuing them. Lehman knew this. They bought the companies anyway. By 2006, Lehman was the largest underwriter of mortgage-backed securities on Wall Street, packaging an estimated $146 billion in mortgages that year alone. The fees were extraordinary. The risk was being transferred to someone else, or so the theory went. Here is where the arrogance becomes structural. As other banks began quietly reducing their exposure to mortgage securities in 2006 and early 2007, as the first whispers of default rates climbing above projections began circulating, Lehman doubled down. Fuld and his executive team made a strategic decision to retain more mortgage assets on the firm's own balance sheet rather than selling them all to investors. They believed prices would recover. They believed their models. The assets stayed. The prices did not recover. By early 2008, Lehman was sitting on an estimated $85 billion in real estate exposure, in a market that was visibly collapsing. Their leverage ratio at peak was approximately 30 to 1. That means for every dollar of equity, they had borrowed 30. A 3.3% decline in asset values would theoretically wipe out the entire firm. The declines were not 3.3%. In March 2008, Bear Stearns, another over-leveraged investment bank, collapsed and was absorbed by J.P. Morgan in a Federal Reserve-facilitated rescue at $2 per share. The market assumed Lehman was next. Lehman's stock began to fall. Fuld called the short sellers criminals. He did not reduce the leverage. Over the summer of 2008, Lehman's leadership explored potential rescues. A deal with Korea Development Bank fell apart in September. Talks with Barclays and Bank of America were conducted. Treasury Secretary Hank Paulson, who had decided the government would not use public money to bail out Lehman, watched the negotiations fail in real time. The weekend of September 13th and 14th became one of the most consequential 48 hours in financial history. Bank of America chose to acquire Merrill Lynch instead. Barclays walked away, blocked by British regulators who declined to approve the transaction without a shareholder vote, which would take months no one had. At 1:45 in the morning on September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection. What happened next was not a metaphor. It was a mechanical seizure of the global financial system. The repo markets, the overnight lending markets that banks use to fund daily operations, froze. Money market funds, considered the safest of investments, began breaking the buck, meaning their value fell below $1 per share. This had almost never happened. It was now happening to multiple funds simultaneously. Within days, credit markets around the world stopped functioning. Companies that had nothing to do with mortgages could not borrow money for routine operations. The contagion moved faster than any regulator's model had projected, because the models had not included the possibility that a firm of Lehman's size would simply be allowed to fail. The Federal Reserve and Treasury Department launched emergency interventions of a scale not seen since the 1930s. The TARP program authorized $700 billion in emergency bank support. The Fed extended credit facilities that would ultimately reach an estimated $7.7 trillion at their peak exposure, according to later analyses of Federal Reserve data. Global stock markets lost an estimated $10 trillion in value in the weeks following the collapse. In the United States alone, unemployment rose from 6.1% in August 2008 to 10% by October 2009, the highest rate since 1983. An estimated 8.7 million Americans lost their jobs. Roughly 3.8 million homes were foreclosed in 2010 alone. 25,000 Lehman employees lost their jobs on the morning of September 15th. Many held company stock in their retirement accounts. The stock was now worth approximately nothing. Richard Fuld had sold an estimated $480 million worth of Lehman stock in the years before the collapse. The timing of that is left as an exercise for the viewer. Fuld testified before Congress in October 2008. He said he felt horrible about what had happened to his employees and his investors. He also said he had done the right thing every step of the way. He was not charged with any crime. He maintains this position to this day. Here is the lesson, and it is not subtle. Lehman Brothers did not fail because of bad luck or unforeseeable circumstances. They failed because a culture of aggression, internally rewarded and externally celebrated, made it structurally impossible for anyone inside the firm to say stop. The mortgage risks were flagged by internal analysts. The leverage concerns were raised by at least one senior executive who was subsequently sidelined. When an organization treats dissent as disloyalty, it does not eliminate the risk. It just eliminates the people who can see it. A firm 158 years old. Gone in a weekend. The empire was never as hidden as the warning signs. Next, how a company that once dominated the mobile phone market managed to turn a 10-year head start into a cautionary tale about the one thing no monopoly can afford to lose. Subscribe for more hidden empires.